Oppenheimer Asset Management Chief Investment Strategist John Stoltzfus is with us. His firm has an S&P target of 5,900. That, I think, remains, John, the second highest on the street.
Yep.
Any misgivings at this point?
None whatsoever at this point. I mean, we're watchful, most certainly, but I think it was just as Sarah was saying, you know, things are, when you look at it, while there are concerns, like today, the declines that we're seeing are reflective of, well, what happens with these numbers? But most of them are short-term trading oriented and natural before a number is released because of the vulnerability for short-term traders with options positions. But for intermediate to longer-term investors, this looks like, if anything, if we get any kind of a pullback this month, if that softness comes through, there will be opportunity to catch some babies that get thrown out with the bathwater.
So you think 5 to 10 down in the next couple of months, you'd be ready for it?
Oh, I think you always have to be prepared for that, Carl. There's never an all-clear signal. There's always, what in the old days, Barton Biggs used to call it the bolt from the blue or a sock to the jaw. But we're not seeing that. And it looks to us, when we look at it, the economy is showing resilience across the consumer, across business, across job postings on a healthier basis rather than expecting numbers that are too large.
But again, how much of that is already factored into this market, which is up 17% year to date, NASDAQ up more than 16% year to date? Does that make us more vulnerable to some of these other risks out there?
I think not quite as much as so vulnerable, but most certainly likable to get a haircut. You know, a trim or a haircut is always possible. But from these levels, we'd have to say it still looks to us very similar to what we've seen this year when we get these periods of pullbacks. It's a relative taking the market down for maybe perhaps a little bit of froth in certain areas, or just diversifying now across the sectors. The rally from the October lows of last year has been very broad. The rally from the start of this year was narrow, but now has broadened of late. And so what we're seeing now on a day-to-day basis, you get the traders are moving in and out of positions, but so are intermediate to longer term investors moving towards greater diversification. So we look at it, we think the economy is in relatively good stead. And the earnings season with 11.5% earnings growth, much better than expected.
What's happening expectations from here on earnings?
Yep. And I would expect that we'll likely see, similar to first quarter and second quarter, positive surprises. I don't think we're going to, just what you were mentioning in terms of the comments from different companies, all of a sudden consumer discretionary, it's been realized, and we've said that all along, don't bet against the American consumer. Because the American consumer, when times are flush, spends like a sailor at the end of a long term of duty with a lot of money in their pockets. On the other hand, when times are tough, they'll take the vacuum cleaner out and vacuum the back of the sofa and the back seat of the car and keep shopping.
Right. It does feel like for those who want to push back against a bearish narrative, they pull out financials first. And the XLF chart does not connote concern.
You're not kidding.
What's going on there, do you think?
Well, I think what it's really saying is that we're moving towards a normalization in terms of interest rates. I mean, we're in an environment now where even with interest rates likely to come down, with the Fed likely to cut 25 bips on September 18th, what you're looking at is you've got a situation where bond issuers have to pay once again for the privilege of borrowing money. That helps diversification, especially with many seniors who like fixed income type products. And on the other hand, it's an environment which for CFOs, it calls for greater responsibility in working their business plans through, because money costs more. That's not a bad thing. It's actually healthier. As long as we're not in an emergency, we don't need rock bottom free money.